Hello and welcome to the Saxo Market Call podcast. We are back and my name is as always Søren Otto. And after a few pre-recorded episodes over summer, as I said, we're back here in the studio recording live to all of you audiences. And boy, have I been excited about this because we're not only back, we're also launching a new format. And that means that we're going to go from doing a couple of shows a week to do once a week. We're going to still do some news updates, but obviously they're going to be more related to weekly performance and what has happened past week, what's going to happen in the coming week, instead of doing a sort of a day-to-day stuff. But then what we're going to add on is that we're going to have a more thematic focus. And we're going to focus on, obviously, all the things that are relevant for investors. And one of the extraordinary things that I'm looking very much forward to is that we're not going to just have one guest as we've usually had. We're going to add more guests. And today I'm actually flanked by two of our great guests. One who you haven't heard from a lot in the past year or so.
But you heard from me a lot before that.
Definitely. And I feel very honored to almost be in your seat here. But let's just start another place. And I just want to ask you guys, because it's been such a crazy summer, especially on the financial market. So I want you guys to answer before I introduce you. Peter, what was the most crazy thing you thought happened in the financial and political world over summer?
I want to say Trump, but maybe that John is what John will say. I will say that the single largest decline in Japanese equity market since at least 1987, and if you use not the Nikkei but the Topix index, potentially it was the largest decline since the early 1960s. I think that was pretty crazy.
And John, I think Peter almost teased for what you wanted to say. What do you think?
Well, it kind of goes without saying. We had an assassination on a presidential candidate and former President Trump. With no secret there. Shot in the ear and very incredibly lucky to have escaped with his life because he turned his head at just the right moment. But then not only that, but the degree to which we sort of turned around and forgot that story. I mean, just that, this, I remember when there was an attempt on Reagan when I was about 8 or 9 years old, and that was such almost a trauma at the time. This one seems like the news cycle just moves on. And then second to that, the exit of Biden and the surging of Harris's outlook and the polls relative to the former ticket, somebody that was seen to be extremely unpopular before, suddenly the favored candidate, not by wide margin, and we'll talk a lot about that today, but that was just, to me, this been quite a shocking turnaround in the political outlook here in the U.S.
And with that, I am very happy that we got sort of an audio introduction to the two experts here, but a more formal introduction is always appropriate. And obviously we have you, Peter Garnry, here, head of Saxo Strats, and you've been a very frequent guest sidelining me for the half year we've had the former structure, but now with the new structure, I'm also very happy to know that we can invite you back, John Hardy, who was a former host of this podcast and former FX strategist, and also still a very active follower of the financial markets. You've moved up to change here at Saxo, which is why you haven't had that much time to be in the studio, but very happy that you'll lend some time. And one of the reasons why you're here is that because after the news segment that we're going through in a minute, we're going to talk the U.S. election, and you are very interested in that, so obviously very relevant to have you here. And then this is probably going to be a little bit of a long podcast because we also need to discuss this market crash that we saw last week, early last week, Monday especially, and also the connection to the U.S. election. Is there any connection to all of this commotion that's been related to the U.S. election? But for now, let's go to the news and the current status on the markets. And Peter, we used to do this equity update, which we did once a week previously, and you usually ran through the performance figures there. Now, obviously, it's been a while since we've been here,
Absolutely.
So I guess the performance of the past week doesn't really make any sense to look at. So could you just sort of give us more of a rundown of how has markets generally performed over summer?
Yeah, let's step back just a little bit. So around mid-July, the markets were still running high. We had a couple of earnings releases from Microsoft and Alphabet, the parent company of Google, where investors began sort of the conversation. Okay, these investments in AI are they basically too high and too much relative to what can be recouped in profits? And that set in motion sort of a chain reaction in technology stocks slowly sold off. We had the Trump event, as we talked about, that and the Harris campaign also changed the landscape there in the US. And then we had going into that week with Bank of Japan. It was well telegraphed, but still the market reacted to it. They raised the interest rate a little bit. There was weakness coming into the Friday's numbers. We had a weak job report. After the dust settled, we can sort of say, and this was late July, we can say that there was a temporary causes. There was a lot of immigration, expanding labor market supply, and there were some temporary factors from hurricanes in the US. Regardless of that, there was a chain reaction that was set in motion on Friday. And when we came into the Monday, we had that big 15% drop in Japanese equities. And we all know that there was a huge carry trade going on in the market because of the very wide spread between the interest rate you're offered in Japanese banking accounts because of the policy, and then the US. So a lot of carry trades were put on naked, so you don't hedge your currency exposure. So when you suddenly had the move from Bank of Japan, you had a strengthening of the Japanese yen, and that very quickly erodes the profit you're seeking by that interest rate differential spread. Before John comments a little bit on that, and that sort of accelerated a lot of things. And then we had a big blow up in the VIX. We've seen this before. We've talked about it on with our clients. There was the biggest trade on Wall Street right now, as Bloomberg called it some weeks before, the dispersion trade. And I happened to just write about it before I went on my summer holiday. And surely enough, also I think we have seen that from other market strategies at Goldman Sachs, etc. That was a contributing factor to why it also became a little bit wild in the US, and the VIX touching almost 60.
Yeah, sorry to interrupt you and to jump ahead of you, John. Could you just quickly explain what you mean with the dispersion trade? What's that about?
Okay, so it's very simple.
Quickly, Peter, it's not simple. It's hard, isn't it?
Okay, I'll try to keep it simple. So stocks, they fluctuate against each other. In equity markets, a lot of stocks fluctuate a lot with each other, also called correlation, and those correlations are typically very high. So when correlation is low, it's because stocks are moving in opposite directions all the time. We had a correlation index by the CBOE, which is an options exchange in the US, that is measuring how much stocks in the US are sort of fluctuating with each other, and that hit the lowest level ever. And the idea about the dispersion trade is that you sell the VIX futures, so you have futures on the VIX. You cannot trade the VIX.
In other words, selling volatility on the broader index.
Yes, yeah. And now it becomes a little technical, but the simple thing is that the curve on these futures are always going up. So when you sell them, you roll down the curve and you make money because volatility never ends up most of the time to be as bad as is priced into the future. And then simultaneously in that dispersion trade, you go long call options on various stocks that have very low correlation to each other, and maybe even have some event risk coming in, an earnings release or some other type of event that could move the stock. And that type of strategy was extremely profitable for at least a year, and there were big money involved in that trade. I hope everyone got it. Although we can always go down into further details, but that in a nutshell, that is the trade.
But the indirect expression of it was the incredible ramping of Mag 7 and the NASDAQ 100 that we saw ahead of this event. So we talk about, this was a traumatic market event, but we're simply unwinding. We bombed ourselves all the way back to levels in June, right? I mean, it's not like we, at least in the U.S. industry, with Japan, like you said, it's this what was your word? Chain reaction. Yeah. Because you had the combination of risk off, a more powerful yen, and leverage into the currency.
Index concentration.
And that concentration or that chain reaction or cocktail was extraordinarily vicious in the case of the Japanese equity. So, I think the chain reaction or cocktail of factors was the key here. And we have to remember Japanese yen and Nikkei aside, and we've seen a huge recovery in the Nikkei. At least half of the gains have been already recuperated. It was just a reality check, and this was just some key events that sort of stuck it to these trades and sort of deflated a bubble that was rapidly inflating here locally. It doesn't have to mean anything about the election. Doesn't have to mean anything about, this is a new a depressive market here.
It was a wake-up call that this free lunch that almost seemed like since early October 2023, when the market sort of came to the conclusion that we are not running into a recession and inflation is cooling down enough for the Fed to at least begin potentially a rate cutting cycle in 2024 that kickstarted a rally, and combined with all this options trading and the dispersion trade, as John said, we basically rallied extremely hard for 9 months, also with AI as a turbocharger. So I think it was just a reality check, and so there is no free lunch. It cannot go up like this forever anyway.
Okay, and we'll definitely gonna touch upon that a little bit later as well, although we may have covered most of it. But in any case, if we just take the near term, this week one of the focus areas has been the CPI, and there's still also earnings rolling in. With all of this drama and this reality check, what's sort of the status that we're leaving the financial markets in right now? Are we still in sort of an okay atmosphere, or are we dreading that something dramatic will happen again soon?
Well, we just before we went into the studio, the CPI for July was released in the US, and there was a surprise to the downside. So you can say that it supported the mood and the sentiment you have in the market. The Nasdaq 100 is projected to open higher when trading opens today. So it's what can we say, Søren? I mean, I think that as long as we don't have an evolving picture where it is becoming extremely clear that the US is rolling into a recession, I think the market will hold itself together. And especially the market, I think, is appreciating the current trajectory. The market is sort of fluctuating between 4 or 5 rate cuts by December this year. And that's obviously is going to... So small rate cuts, I think, is positive for equities. If it suddenly becomes a little bit panicking and we do 50 basis point, and it's predicated on weak economics, then it's a different story. So I think it's a balancing act from the Fed, I think.
Yeah, it's also critical to watch the reaction function to surprising data. So inflation going down is a hooray moment, at least as evidenced by the last couple of days of action. A missed PPI on the core, a missed CPI, and you get lower rates. Hooray for just disinflationary news. But we also had a weak retail sales report. So I think that the indicators that talk about growth rather than inflation, if those are weak, I would be surprised to see the same bad news is good news reaction, because the concern would begin to tilt towards, at some point, recessionary fears. And I think we can connect that to the presidential election cycle, at least for the longer term. Eventually, what scenario would lead to a quicker response? But that's something I would look out for. Flag for the sort of beyond the economic data releases beyond here.
Yeah, definitely, and that's a very good segue, John, because I think now let's move on to the U.S. election talks. Because as we said in the beginning, and especially as you highlighted, John, we did see a lot of events unfolding, a lot of things you don't usually see related to a U.S. election that took place over summer. We had Kamala Harris replacing Joe Biden as the Democratic candidate. We had obviously an assassination attempt against Trump, and we've also seen J.D. Vance and Tim Walz being introduced as the vice president candidates. I guess the big question for us, because I mean we are finance people, has any of this impacted the markets in any way? Have you seen anything, John?
I think Peter's the one to talk to on that. I think broadly speaking, I've not seen anything, but I don't know if you noticed anything in some of the sectors, because we have pulled out sectors that we think are more or less significant to a Trump outcome versus a Harris outcome. I'm really reluctant to say you can pull anything out of the madness of the late July, early August period, because I think we just ran through all the factors that contributed to that. I think politics is something people are thinking about, looking forward to, and we can start to analyze volatility curves. But I'm reluctant to believe there's been much move so far.
I think that if I was to pinpoint one part of the market reaction where you said, okay, I think I'll attribute this to Trump's assassination attempt, because remember, going back, the narrative when the assassination attempt happened, Trump is going to win. It's a sure win now, right? You saw briefly a big rotation in the stock market. Small caps in the US were rallying pretty hard. And I think that came with the notion that Trump would win. And he talked a lot about these tariffs and, drumming up domestic demand. It's US first again. So it's a little bit back to the playbook from when he was running for presidency the first time. So I think that was the only signal I could pull out of the market. Anything else, I think, drowned in the AI sentiment breaking down, the discussion about the economy and inflation and all that.
I partially agree, and I wonder, though, if that was sort of the algorithmic, clever hedge fund conclusion, and somebody slammed a bunch of futures through because it lasted about 2 days.
Yeah,
and then it stopped.
I will not argue against
that crazy Russell rally. But of course, it's a key point, and it does mean, and it is an indicator that people are thinking about these things. But it's really tough to gain this election from here. But we'll increasingly be doing so into early November for sure.
Yeah, definitely. And as you're saying, we are ramping up our content production also on the platform. And one of the things that we have already put out is sort of very, very early stage expectations of which sectors, mainly equity sectors, could be impacted by either presidency. Obviously, we did this back when Biden was the Democratic candidate, and there we listed clean energy, infrastructure, financials, and semiconductors as 4 areas that would probably have a positive reaction to if he was elected president. Now we have Kamala Harris, and to my mind, we're still missing a lot to see about what her campaign will run on. But Peter, do you have any idea of whether this is going to be sort of the same sectors that are going to be impacted, or whether we should see any shift there?
I think that Harris or not, I think I would change maybe the list a little bit. I think the clean energy, renewable energy, I think that's given. That's more positive under a Democratic presidency or administration. The infrastructure, so. I think infrastructure could also do well under a Trump administration. So I think and then the financials versus semiconductors. I think the financials, because of Trump's deregulation drive, I think probably lies better under Trump. But I think something that could swap or could be pushed in is actually emerging markets. I think that emerging market stocks and investors that are looking at the emerging markets would favor and look more optimistic on the emerging market equities under a Democratic administration than a Trump administration. But again, I like to quote Mark Howard. Mark Howard, right? The macro hedge fund manager.
Could be.
Yeah, that it's all a guessing game, right? And I think actually that is to be fair to the complicated process and figure markets out. It is a complicated system. So we are guessing a little bit, but I would guess that emerging markets would benefit under a Democratic administration.
Just a little counterpoint to that. If you want to know what emerging markets are going to do, and I do not, it's about what the U.S. dollar is going to do, because it's all about global funding. And Trump has said he likes a weak dollar policy, with the framework being weak dollar makes us more competitive, means we get more of the exports. We all know that's not how it works when we have a global reserve currency that is also a national currency. So the key thing is that his policies he likes are in diametric opposition to that. In other words, he wants high tariffs, he wants tax cuts, he wants fiscal expansion, all classically very, very currency positive. But he also wants low rates and maybe to interfere with the Fed. And it's only via that last lever, something that's irresponsible, that pulls rates lower than they should be in the U.S. by some political interference, that I suspect could keep the dollar lower. That, or because we finally get through a recession and the Fed is easing to get global liquidity and U.S. liquidity higher again to encourage a recovery.
Yeah, and just to sort of make all things equal here, the list we created for Trump when we did the Biden list was that probably European defense relative to his stance against NATO was something that could perform well, and also U.S. real estate and U.S. small caps. From what I listened to here, might be a little bit in doubt whether that would actually be the case, or is that still what we expect?
I feel still pretty comfortable with that list. You could add, I mean, the U.S. real estate is an interesting topic, right? Because I think that Trump is an individual that is more likely to try to intervene or at least mold the perception inside the Fed to do more on interest rates. Whether or not they do it, that's another question. But he will definitely talk into lower interest rates, and he has a huge network of friends in the U.S. real estate sector. That's why we put it in. But he has this deregulation drive, and that's why I said I would swap the financials from the Harris list to the Trump list, simply because I think financials generally like deregulation, because deregulation, it simplifies things. It could also increase loan demand from large U.S. companies, etc. There's a lot of indirect effects into the financial sector from deregulation.
And then I think one thing to make clear, at least from my point of view with the current setup, is it's not just when you're talking about these political outcomes, you have to think about potential impacts. And for potential impacts from policy in the U.S., you have to have not just the presidency, as Obama very much demonstrated in his 8 years in power. You have to have both houses of Congress. Otherwise, you simply don't get your agenda done in any way, shape, or form. Hence the very powerful Trump tax cuts that came about in 2017, because for those 2 years, 17 and 18, he had both houses of Congress. And hence Biden, by getting that last little seat in Georgia, just by the hair of his chinny chin chin, was able to pass the huge fiscal packages. I mean, monstrous fiscal packages that never would have passed. And they only passed actually with reductions because Joe Manchin, a now independent former Democratic senator, was making a pain to the Biden administration, a pain of himself, because he didn't want to go full force on this fiscal expansion. So on that note, 2024, to me right now, unless there's a further surge for Harris, Trump in any level of victory, small or large, gets it all. He sweeps both houses of Congress. On the other side, Harris, it has to be an incredible move further in her favor, I think, for her to get the Senate as well as the House of Representatives, because of the Senate election map, which is by coincidence just incredibly tilted towards Democratic incumbents.
And there are some very good maps, realclearpolitics.com, where you can find this map of where you have the states that are up for grabs for the Senate. And I think there are 34 seats that are up for election. 33 of those are normal, and then there's a one-off that is not a normal Senate seat election. And I read somewhere that 23 of the seats are Democrats that are up for this election, and many of those are in states that was actually leaning Trump last time. And then I think it's also what you've been talking about, John, that it's just that the roadmap for a sweep for Harris looks very difficult. Although, the predicted markets, which are these markets where people put money on who wins, I mean, it is extraordinary, not meltdown, but just the widening gap between what the market thinks in terms of who wins the election. And you know as well as I, John, that I think our whole idea about polls and markets and how good they are at guessing about politics have been severely disrupted with both the Brexit and the Trump victory back in 2016. So I'm not here saying that this is the definite answer of where things are. I'm just saying that that's where people are placing their bets right now.
Yes, but that is, again, that's simply an outcome of Harris versus Trump, not on these Senate seats.
Exactly.
And there's a more sophisticated pitch. We're going to get into the weeds if I start talking about individual seats, but one of those, Manchin is retiring. He's not Democratic. You said 23 Democrats. You have 19 Democrats. You have 4 independents.
Yeah, that's true.
3 of which are always go with the Democrats, but one of which is Joe Manchin, and he is very much in a very Republican state, one of the most Republican states, West Virginia. Looks like the guy is polling something like 30 points ahead of the Democratic challenger for that election.
Wow.
So not only would Democrats, and then there are only 11 Republican seats up for election, so they would have to somehow get that seat back and get that seat back by taking one of those 11.
Yeah.
So that would require just a massive further shift, to my mind, in Harris's prospects. I'm not saying it's not going to happen. I think we need to see that before we can start to even entertain that scenario.
I think definitely that's something that we should dig more into once we get a little bit closer, because obviously we have a lot to talk about here, and just a little bit of marketing. I mean, you two gentlemen did a very nice video talking about a little bit more in depth, or at least angled in a slightly different way about this the other day. You can watch that on our platform where we have this US election page.
If you don't want to listen to us for 30 minutes, you can get the 4.5-minute version in that video.
And you won't have my bad jokes.
And of course,
either.
we're burying it here deep in this podcast, but it is, I think it was a very sort of good, reduction of the key essence of 2 scenarios. What are those 2 scenarios, and the headlines on how that might impact your portfolio.
Definitely. Here at the very end, before we move on to the final block of this podcast, do you have anything else you want to say about the US election now? We have spoken about it a little bit.
Next steps. The Democratic convention, will Harris ever sit down for an interview? Will there be some kind of fallout? I mean, right now she can do no wrong, but she hasn't done anything besides some very effective rallies, and there's a lot of enthusiasm, but is there a mean reversion, or is there a continued surge? That's my big outstanding question.
And there is a presidential debate coming up between Harris and Trump.
Indeed.
So that is going to be, I think, a check-in, as you said, on the momentum. Or is it mean version for Harris?
And is that late September or something like that?
Early September.
Early September is around the corner.
Oh, wow.
Yeah.
And how about the vice presidential debate? I know there was a lot of unclarity about when or whether that was going to happen. Do you have any?
Well, the only thing we can say is that the if you look again, take it with a grain of salt, but the way the prediction markets and the bets, they change pretty dramatically around the nomination of Walz as the vice president versus Vance, which has really probably have had the worst start for any vice president candidate in a U.S. election in I don't know how many decades. So and Vance, obviously there is this friction that Vance is part of the group that really supports this project 2025. We won't go into details of that. You can look it up on Google and find out what that is. But it's a project for how to radically change the U.S. government in case Trump wins. And Trump is sort of trying to distance himself. And then you had this interview between Musk and Trump, where Musk he now fully supports Trump. They were not happy friends in the past, but now they are. And he even almost joked that, hey, maybe he could join the U.S. government alongside Trump if Trump won it. So it's like interesting.
And then he could do like the former Treasury Secretary and sell his stock because anyway, never mind. I won't go into that.
True. Next subject.
Next subject.
We'll do like a B rolls like side cut edition of this.
I think JD Vance was a massive own goal by Trump that was done in a moment of when he was on a high. Kowtowing to a base, and I think he's an extraordinarily unpopular person. And at this point for the Trump campaign, and this is just an independent observation, is baggage for the Trump campaign. So I wouldn't even be surprised if he fires the guy before we get to the election. But we'll see.
We will see. So time flies when you're more than two people in here, but
Yes.
that's just great. I love the enthusiasm and the discussions, gentlemen. I think this last blog I originally designated to talk about this market crash, but I feel like we've spoken quite a bit about it. But I think let's talk about it in another light then, because we saw something that was more drastic than we've seen probably in years, at least relative to a lot of things. But where does that leave us now? Like if you were to go out and be an investor now, should you shake on your hands more now than you would have probably 2 weeks ago, or where we're at?
I'm not shaking on my hands. As I laid out in one of my notes to clients when all of this happened, is that rule number one: stay calm. Nobody makes good decisions under panic. So unless you're running a computer system, then if you're a normal human, stop and think. It was very clear, obvious from the get-go that there was a lot of technical details about that. We've recovered, and it speaks a lot about the market ecosystem, right? So we have all these things. We have talked about it: the options market, the carry trade, all these things. But then one of the things that also have changed in the market dramatically over the past 10 years is the participation by retail investors. And I think we saw it very clearly in our flows here at Saxo. While there was panic and sell-off, you could just really see Saxo clients being optimistic, aggressive, buying a lot of shares that was suddenly on for sale.
You mean after the sell-off?
After the sell-off had intensified, we talk about Monday coming into the U.S. session, the U.S. stocks were down 6%, etc. You could just see in the flows that you had this retail, and so on the one hand, the market is more fragile because of how the options market has evolved, or the carry trade, all these things, dispersion trade. But then on the other hand, there's this balancing force with retail investors because they naturally long and they like. We've had this reinforcement in the market since 2010 by the dip. It's a narrative, it's a frame that is used everywhere by retail investors in forums, etc. So it's very ingrained automatic reaction. I think medium term, as I wrote in that note on that day, after telling people to calm down, was that the real worry and what you should think about is whether we have a recession or not. Because if you have a recession and you have a portfolio that is very concentrated in the technology and you haven't thought about diversification, could be just, diversification can have many angles. It could be, a better diversification inside your equity exposure, point one. Point two, do you want to have a little bit more cash exposure? You're still getting a good interest rate on cash, right? And that's sort of an option should the market fall even more. And then you can take some opportunistic bets around that. Should you add a little bit of bonds to stabilize the portfolio? I think these are the deeper thoughts that listeners should think about. Whether we get a recession or not. And I don't believe it's coming right now. So you actually have time to prepare and plan. So do look at your portfolio. If it only contains NVIDIA, ASML, and the likes, please consider other things. and diversification.
And also learn from the experience. Look at how your portfolio behaved relative to the market. And if everything was moving exactly together, then you might think, this is maybe dangerous, because if we do get this real recession scenario, let's say we get a Harris victory, we have gridlock, and the fiscal response is very poor, and requires that we have a long drawn out, or we see a long drawn out recession. So we don't know what this recession might look like, and then these drawdowns could look like the 2000 to 2002 drawdowns, which of course. What is the drawdown? Is it a 2-weeker, or is it a 2-year-er, if that is a thing? So we don't know. So it's just about being playing on the diversification theme. Will keep you better through whatever kind of a correction we see. I guess is the salient point there.
Okay, so I think we reached the end here. Do you have anything else you feel like you want to share with the listeners before we say thanks for this week?
No, just stay tuned. We have a great U.S. election page that's getting up and running. We'll flag that in the future. Lots of stuff coming, also from me. We'll have a weekly update that's getting going next week. We'll certainly be doing more videos and podcasts, maybe special editions. Who knows? We're going to have lots to talk about with this election. I'm a bit passionate about it. I'm maybe, as you can hear from my accent, a native speaker and a citizen of the U.S., so I've got a lot of I've been looking at this through, I don't even want to count how many election cycles now. So I'll be covering it closely, and I'll of course be talking about it as much as I can, and hopefully folks will find that of interest as well.
And I surely trust an American to speak about U.S. politics. I actually hate myself when I talk too much about the U.S. election. Yeah, but it's just that because I have the same reaction when Americans are talking about what's happening over here in Europe, especially around Ukraine, etc. Like, you're sitting over there. You don't know anything about what's going over in this continent. And I think they feel the same. Like, who's Peter to tell me about what he thinks about the U.S. election? But I have some perspectives. But it's just I really appreciate your because your background, John, not only in markets but also because, as you said, you're a U.S. citizen. But I would, as a final note, I would say that as we speak, the U.S. intelligence agencies are warning of a potential pretty large strike from Iran into Israel. So the geopolitical situation in the world is by far still the largest risk source out there, and probably something I'm more worried about than a recession, because that can be rectified by policy measures. Whereas geopolitics, it's deep, it's long. And it's also something that is very difficult to sort of, it's very difficult to create portfolios around it, except for, as we talked about endlessly, Søren, you and I on this podcast. I mean, European defense stocks is one way, I think, to add a component to your portfolio that can shield you a little bit, I think, against a geopolitical future that looks quite uncertain.
With the U.S. administration, with an enfeebled 81-year-old at the top. So it's a very delicate period for a U.S. response around some of these things as well, just to put in that final remark from my side.
You guys really know how to end on a high note, huh?
Sorry.
Hey, be happy. Don't worry.
No, but at least a high note here from me is that I'm so happy to have you guys back in the studio. It's such a pleasure doing this podcast with you again. And to all of you out there, I hope you like this new format and that you want to be with us on this journey. If you have any feedback, we have this mailbox that's marketcall@saxobank.com. If there's anything you think we can do better or anything we should touch upon. But on behalf of John, Peter, it's a Saxo Market Call. Everybody here at Saxo, thank you so much for listening. We will be back next week, most likely Tuesday. And until then, happy investing.